What is going on, investors? Hopefully, guys are doing well out there. Time for the tech sector to kick off its earnings with Microsoft. As they reported their Q2 earnings after the bell today, we'll get into them. Not only will we take a look at the Q2, but we waited a long time to post this video as the earnings came out nearly 2 hours ago because the company gives Q3 guidance right around 3 p.m. Pacific time on their conference call, and I took notes on that, and we'll give you an idea on the Q3 for Microsoft. Just to give you a little clue, in the after hours, the stock was up over $251 per share, but after announcing that guidance, we took a U-turn, now down to about $245 per share, or just up 1.2%. We'll certainly see the follow-through for Microsoft heading into tomorrow. Now, a lot of bad news already priced into the stock, okay? The stock's down over 18% over the last year. Over the last 6 months, still down about 6.5%. Again, this is on the heels of announcing those Q2 earnings. Now, Microsoft's on a funky quarterly system. Next quarter will be Q3 when it's most companies' Q1. Revenue is coming in at $52.7 billion. We'll come over here and we'll show them to you from a financial perspective. We'll roll through all the financials so you got a clear picture on what's going on for Microsoft in the most recent quarter. That was just 1.9% growth year over year on that revenue side, and it missed expectations by about $450 million, as Wall Street was expecting a number closer to $53.1 billion, and we came in at $52.7 billion. Non-GAAP EPS, $2.32, that beat by 1 cent. We'll show that to you from an operating perspective, and we'll also show you the different business segments as well, as you had some businesses, including Windows OEM, impacted by that lack of PC demand. That was down nearly 39%. We'll talk about that more here in a moment. But let's focus on Q3 as well. That's the big thing with Microsoft. So they talked extensively on the call that they saw a softening of demand, particularly in the United States, really across all of their business lines outside of probably cloud computing. But you see it softness in ad business. You see softening in Xbox. You see softening really across the board with the company. And that gave us Q3 expectations for the company coming in at $52.67 billion. Wall Street was expecting growth of about 6.7%. The high-end estimate on Wall Street, you got 34 analysts covering this company, wanted revenues to be at $57.33 billion, and the low end was close to $51.25 billion. On the conference call, they essentially announce it in the different business segments, and while you are seeing some growth in here, you see your revenue guidance totals, once you add up, they essentially give you a range on the conference call. The low end range was for $50.5 billion. The high end range was closer to $51.5 billion. Again, I'll remind you that Wall Street was on the low end, was expecting $51.25 billion. So even on the high end revenue guidance for Q3 for Microsoft, they are coming underneath the mark. Now, they talked about extensively on the call that you have a lot of FX, foreign currency impact, and so that is going to negatively affect earnings. That's negatively going to affect revenue to a certain degree as well. So something to keep in mind, it could be that Wall Street's adjusting. Again, the Wall Street estimate was for $52.67 billion. It looks like we're going to come up a little bit light when it comes to Microsoft. Now, obviously, the buzzword of the week and the month and maybe the year is this Chat GPT, and they talked extensively about AI and a little bit about OpenAI on the conference call. We'll certainly get to the question and answer session. We'll talk about that on our Friday Fang Stock recap show. Microsoft announced a multi-billion-dollar investment into OpenAI, which is the maker of Chat GPT. It's believed, according to Bloomberg, that investment might be worth up to $10 billion. That is actually a very large percentage of the company. So essentially OpenAI, largely owned by Microsoft, if the rumors are true. Microsoft's going to lay off about 10,000 employees, take a $1.2 billion charge in Q2. That could be softening the blow a little bit when it comes to Microsoft, and the fact that your revenue guidance looks a little weak, your earnings look a little bit weak. When we go through this, there's some segments of the business that look particularly weak, but we're going to lay off a bunch of people, take a charge, and then finally by probably Q3, Q4, Q1 of next year, you're probably going to see the impacts of those cost cuts come through on the EPS side. Now, obviously, you have Activision as well. This is being held up by regulators, not only here in the United States, but in the European Union and across the world. No real significant updates here other than the fact that if this deal doesn't go through, Microsoft doesn't have to shell out of 50 some odd or 69 billion, excuse me, 50 billion. We're talking about $69 billion. If this deal doesn't go through, they have to pay a $3 billion breakup fee, which to this company is almost like $3. So I don't know how negative it would be if this deal doesn't go through for Microsoft. And to a certain degree, the market is pricing in that it is likely not to go through. Now, come over here and look at the segment results. There's two different columns. You got the left-hand column where you've got the year-over-year change. This is generally accepted accounting principles. On the right-hand side, it's showing you the impact of the strengthening dollar versus virtually all currencies out there that Microsoft does business with. And so I'll let you to decide which side of the column that you want to pay attention to. The big one that jumps off the board is you have Windows OEM. So they noticed that they had less demand in their Surface tablets. They had obviously a lot of less PC demand out there as well. And so you're seeing a major drop. We're talking to the tune of 39% in Windows OEM. This is the install base inside PCs as demand for that continues to fall. Now, some big ones though. You have Azure and their cloud services up 38% year over year. I noticed in the after hours, Amazon stock, well, it just turned negative, but initially popped on that news. But clearly the guidance and the conference call commentary sending these stocks lower. All other business units growing very nicely over at Microsoft, but again, slowing in comparison. Now, also, you have the search and news advertising business. Microsoft is one of the first companies reports that gives you a clue into Google and Meta as well. And I noticed in the after hours, Google was up just slightly. Meta also just up slightly, as they are not necessarily tied to as much as Microsoft and Amazon are to server profits. The fact that you still have constant currency 15% growth in search and news advertising, the company said many times on the conference call they saw a lot of weakness in that area, and they continue to see weakness. While everyone expects advertising to be weak, and it's certainly priced in a little bit to Google and Meta stock, having this type of growth over at Microsoft, which is viewed as kind of a third or fourth place player in this business, certainly can ease maybe some worries some investors might have about Google and Meta's earnings heading into next week. Now let's jump into the numbers. Over at Microsoft, total revenue coming in at that $15.75 billion. Again, that was just 2% growth year over year, and it missed expectations by about $450 million. Now, what we love about this company is the total cost of revenue off of $52 billion is just $17.5 billion. So off of this $52 billion worth of revenue, you have gross profits of $35 billion. That was up just fractionally over a year ago. So the company's doing a nice job controlling those cost of revenues. When you look at this on a 6-month basis, paints a similar story. Although Q1 was a little bit better, you see total revenue ticking up nicely, costs ticking up just fractionally, and your gross margins going from 66.5 up to nearly $70 billion. Now, across the board, you are going to see costs continue to rise. You are not going to see really the impacts from an expense perspective on these layoffs until likely Q3, probably more so in Q4 for Microsoft. So that means your operating income is going to go down. When your revenues basically go flat, your costs go up a little bit, and your operating expenses go up. Your operating income went from $22.25 billion down to about 20.4 for the full year. Paints a similar story. Despite stronger revenue growth, or decent revenue growth, I guess you could say that, the cost on the operating side are outpacing that, and you see operating income going from $42.5 billion down to $42 billion. You come all the way down to net income. Paints an exact same story. Your net income is shrinking over at this company. Now, they are shrinking the number of shares outstanding. That's why we don't typically look at a headline or EPS in general, except when it comes to maybe like dividend coverage or something like that, because as the company reduces the number of shares outstanding, despite the lower net income, the EPS doesn't show that impact. I would focus primarily when you're looking at Microsoft on this operating income side. The fact that it is down nearly $2 billion over the last year definitely showed this company was going to have to make some cuts, and in my opinion, might have to make a few more cuts when it comes to that operating expense side. When we come over to the balance sheet, it looks really good. Okay, obviously, this company has like $99.5 billion in cash, but keep in mind, they're on the hook for a $69 billion acquisition. These financials don't include maybe a $10 billion or whatever that OpenAI investment ends up being. It doesn't include about $10 billion here. So while you do have $99.5 billion worth of cash, and then you've got another 35 in receivables, it's a little less impressive when you factor in that if they have to write a cash check, I don't know if they're going to issue shares of Microsoft, take on some debt, whatever they do to fund this $69 billion, they certainly can reach into their pocket and pull it out, but that will make your balance sheet cash position obviously go down tremendously if that ends up happening. You come down here to long-term debt, some peeled off the long-term side, down from 47 down to 44 billion, but most of that, or I would say some of that, just peeled off into the longer term current portion, which ticked up from 2.7 up to nearly $4 billion. We'll see more evidence of that when we get over here to cash flow. So on the cash flow side, I like Microsoft. Some people just give you the 6-month view on a quarterly basis. They give us a 3-month view of cash flows and also the 6-month view of cash flows. You typically on a cash flow statement pull down a net income number, which again, we described over the last year, actually down a little over $2 billion from 18.7 down to 16.5. So despite marginal increases on that revenue, again, this is why the company is laying off workers, because they're only seeing marginal increases on the revenue, but because of increased operating income and operating cost, it is driving down that net income number. Now you get to add back in depreciation, amortization, you get to add back in stock-based compensation as well. You get down to a number, net cash provided by your operating activities, that was at $11.2 billion, down significantly where you were a year ago on a quarterly basis. You're at $14.5 billion. Folks, that is like a $3.4 billion decline year over year. That's a pretty large percentage. And you see the same plays out for the last 6 months. You went from $39 billion of positive cash flow last year on a 6-month basis, down nearly $5 billion to $34 billion. Now, this company flip-flops financing and investing. Most companies I see investing is the second column, so that's what I'm going to read first. You got your additions to property, plant, and equipment, $6.2 billion. This is why, okay, I understand. We're kind of, talking about a story of a rich man here, where they go from $14.5 billion down to $11.2 billion in positive cash flow. Nobody's necessarily going to cry for this company, but look, property and plant and equipment over the last quarter, $6.2 billion. So there's half of your cash flow from operations going all to property, plant, and equipment. Purchases of investments over the last quarter alone, $11.6 billion. So there's all your positive cash flow in a quarter going to just investments before you pay anything else. Dividends, share purchase, buybacks, all those types of things gets wiped away. That's why you've got to control cost over at these companies, even despite these fantastic numbers. You see, similar type of thing plays out for the last 6 months. Off of $34 billion worth of positive cash flow, you got $12 billion in property, plant, and equipment, another $16 billion in purchases of investments. Again, this is not including the massive Activision deal as well. And this is also not including common stock repurchases or dividends, which total over $10.5 billion on a quarterly basis, over $20 billion on a 6-month basis. So off of $34 billion worth of positive cash flow, you burn through $20 billion of it just buying back the stock and paying dividends before you do anything else over at this company. This is why they need to do one of two things, likely two things over at Microsoft. They need to figure out how to reaccelerate this revenue growth. And look, when you come over here to Wall Street, they are expecting revenue growth to reaccelerate starting sometime in Q4, which is really June of this year, typically kind of a Q3, Q2 event for most companies. They're expecting revenues to reaccelerate to double digits out essentially into infinity for this company. So somehow, magically, we're going to go from basically no growth at this company for the next 2 quarters, and then we're going to reaccelerate to double digits. I mean, I don't know. Maybe it shows up. Maybe it shows up somewhere. People start demanding more PCs. Obviously, you're going to have to continue the server strength. Maybe that OpenAI AI investment will drive a lot of growth here, but I tell you what, there's going to be a lot of people on Wall Street. There's going to be a lot of investors that just simply don't buy that it's going to show up. And in fact, if you maintain steady, low single-digit growth over at Microsoft, guess what, folks? If you work there, you're probably going to get a pink slip because they're going to send out more of these as long as that revenue growth doesn't accelerate. Because, boy, they spend a lot of money on dividends, buybacks, property, plant, and equipment, and acquisitions, let alone everything else over at Microsoft. Yes, they generate large amounts of profits, but boy, they spend a lot of money to support it. Now, we are seeing a complete reversal in the after hours. This is why we wait to post these videos, because there's some people that probably got on and say, hey, Microsoft's up 3, 4, 5%. And then after they give this guidance, it is a complete reversal. So I actually had a green bar. I drew this in before the guidance was given. We were up here at about $251 per share with Microsoft. That would actually have represented a breakout above the trend, which we've been looking for on the S&P 500, really all the stocks that we're looking at. Now, the stock has broken above this trend line a few times in the past, so it wouldn't have been a for sure sign that this downward channel that we're in is completely broken, but it is not a good sign that now this upper trend line is absolutely going to hold, and it appears the stock is probably going to come back down here and retest some areas lower inside the green box that we had marked out here on the channel. If you follow us on our FANG Stock recap show, we cover Microsoft from a fundamental kind of news story basis and a technical analysis basis every Friday on the show. There are timestamps in there. If you only care about Microsoft, it'd be about 5 minutes of your Friday to catch up on all the news and the technical chart patterns of Microsoft every Friday. Now, what we are going to watch for Microsoft from a technical perspective is, yeah, it got rejected at this top red line. This red line has been intact really for the last year, not only on Microsoft, but the S&P 500. It's not a concern that it got rejected here. Getting rejected here is not really that big of a deal. If you pull back to this, I'm going to change this red line down here to a purple line so we know exactly kind of what we're talking about. If we start making some lows down here in November, make some higher lows here in January, and then we pull back here, maybe make some other lows, maybe sometime in February, maybe in March down here at 220, 230. And then finally, we have that rebound that we're looking for with the markets, maybe the breakout at some point. This is the start of an uptrend. And considering your previous highs are here at 240, you need a break above that. More specifically, you need to get above really where the stock was in the after hours. It was trading beautifully from a technical perspective in the after hours, popping up to the previous highs up here to 250, like a break above that. Again, it doesn't happen all at once, or doesn't have to happen in this series of events, but we're looking for Microsoft over the next, I would guess, the next month or so. It needs to hold the, we'll call it 220 up to about 230 range. It needs to hold this level. If it retests all the way back down here to 220, it's not the worst thing. It just means you have a shallower uptrend developing. But if you break through the 220 mark and you push down here and retest the November lows, it basically means that this downtrend is very much firmly intact, and these were just shorter term rallies based on either short covering or momentum. And for the most part, there are going to be a lot of investors that are not going to believe sometime magically in the summer that Microsoft is going to be able to reaccelerate to double-digit growth really out into infinity. I am skeptical that this company is going to be able to do that. I think they're going to have to lay off way more than 10,000 employees unless they want these financials to deteriorate even more so. In terms of the Activision deal, I actually think it would be a benefit for this company if this whole thing goes away. $69 billion, not necessarily something they need to spend on one video game company. And then finally, you do have this investment into OpenAI and ChatGPT. Trust me, I was on that all weekend, and it is not perfect. It is definitely a startup, and trust me, there's going to be lots and lots and lots of other companies that are going to be able to throw a lot of money at this type of thing and create a product that is at least competitive, if not better. ChatGPT is not a game changer. It's just simply gotten a lot of the marketing buzz. And if they don't move quickly, other companies and other startups, and maybe even companies like Google could potentially pass them by. Overall, a mixed bag for Microsoft. PC shipments down big. That should really hurt some of the chip makers out there. Server demand still remains relatively strong. Currency fluctuations still are impacting earnings, and the guidance was a complete disaster over at Microsoft, coming well underneath expectations, and nobody is going to believe that this company reaccelerates to this number. And I tell you what, if Microsoft does reaccelerate to these numbers, well, the stock is going to reverse, and it's probably going to reverse very hard, because I don't know a lot of people looking at these numbers really believes that revenue is going to reaccelerate in just a couple of months. Hopefully you guys enjoyed today's video. I'll be back again very soon with the rest of the tech sector, including Tesla tomorrow. Good luck with your investments.